It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, smartest guy in the room, Mr. Michael Becker.
Hey, Paul.
Michael, who has over 5,200 apartment units under his belt, $500 million in assets. Again, I ask you, how do you sleep at night, my friend?
Like a baby.
So Michael, who's a former banker for a large national bank, has gone from loaning the money to now owning lots of real estate. So we really use a lot of his information to kind of get you smart as you can get when you listen to somebody who's actually done it. So we don't do a lot of hyping. We just kind of tell you how it is. And with Michael's banking background and owning background, he is a good person to talk to about what's going on. So what's going on in the Old Capital world for the Old Capital multifamily event on September 13th.
I'm sure people are getting sick of hearing about it, but we have the Old Capital Conference coming up September 13th. So more you guys sign up, we'll stop talking about it. So that's the challenge. Go to the Old Capital Podcast website, which is www.oldcapitalpodcast.com, where you can sign up for the upcoming event. It's going to be, and both Paul and my estimation, the premier multifamily event in the country around workforce housing. It's one of the only ones, if not the only one I'm aware of size that's going to be focused strictly on workforce housing, Class B, Class C multifamily. There, you're going to learn and network with a bunch of the people in the marketplace that are actually out there doing it, and we're going to have good panels as well as some networking, speed networking events. So it's going to be pretty cool. I think I'm pretty excited about that, as well as our keynote speakers, Captain Comeback, the Heisman Trophy winner, two-time Super Bowl champion MVP Roger Staubach, who also is a legend in Dallas commercial real estate investing lore. So I'm looking very, very much forward to hearing what Roger has to say and kind of get hopefully some of the wisdom that he's learned, both from his professional football career as well as his real estate background as well. So that's September 13th at the AT&T Stadium. The theme this year is Get in the Game. So we're hoping that you come out and get in the game and start networking and meeting with a bunch of people.
So it is the premier event. You can't do it by sitting and listening to your headphones while you're driving. You have to actually be in Texas. Got to be at AT&T Stadium. If you haven't been here, you really want to come here. We're actually going to have a number of events. Not only this is a full day event, but the following day we'll have another event too. So more details on that to follow. So look forward to seeing you in Texas. It shouldn't be an Ask Mike Monday today. It should be Ask Mike 2 questions today. So we got 2 questions that came in. Is Mike, how do you figure out how to pay your investors? How do you figure out how to pay your investors? That's question number 1. And question number 2, it seems like most multifamily syndications use a 5 to 7 year sale as their primary exit strategy. Why don't they use a refi to return the investors their capital than a longer-term buy and hold?
So I think the first question is, how do you pay your investors? I think that's really more like, how do you structure the investment and the splits? And there's certainly no right or wrong way of doing this. There's many, many different structures out there. Some of the most common would be either one or two ways. Either you can pay a preferred return with a waterfall structure, or you just pay basically what we call sponsorship equity, where it's just kind of a straight split with no pref. So kind of comparing and contrasting the two real quick. So the waterfall, pref with the waterfall means basically the investors typically get the first 8% or so of the return on their money as paid out in preferred returns. So the investor gets that first 8%. Then anything above the 8% is in what they call waterfall split, which typically kind of start out somewhere around a 70-30, where above the 8, 70% goes to the investors and 30% goes to the sponsor. And then that's typically graduates up with IRR hurdles or internal rate of return hurdles. So it might be a 70-30 up to the 15 IRR, then a 60-40 up to an 18, and then a 50-50 above an 18. So meaning that the sponsor, the more returns they produce, the more percentage of that above it they get back. So that tends to be a little bit more conservative in a lot of ways to the sponsor, where they get their money back first before the sponsor makes money. But it can also sometimes disalign the interest versus going more of like a straight route, which is what we typically do at SPI Advisory. It's just like an 80-20 split with no pref, where we'll return 80% of the returns, all distributions to the investors, where us as sponsors keep 20%. But there is no preferred returns, but there's also no graduated waterfall split up as well. So if the deal's been a home run, like we've been fortunate enough to have all our deals be that we've sold so far, the investors participate more in the upside, where the investors' upside is limited a little bit more if there's a bigger home run with a waterfall. So that's kind of the compare and contrast of the two main ways of how you pay. Certainly, there's certain components that have to either be a current pay, meaning that you're paying your investors some sort of cash flow distribution, either monthly or quarterly. And then there could be some, obviously either a capital gain upon a sale or return of capital when you have a refinance, if that's the route you go. So those are kind of how your investors get paid. Those are the two most common ways that you either do a pref with the waterfall, or you do a kind of no pref with a more defined split. Those are kind of it might be called an override, is what I've heard a lot of people call it, the other way versus the waterfall. So Paul, is that sufficiently answer that part of the question?
Yeah, I think so. I mean, there's not a right or a wrong answer. It's just whatever is able to attract capital to your investment is probably the biggest one. Whatever works for your investors to kind of figure out if they're going to depart with their $100,000 or $50,000 or $200,000 to invest in your deal. I mean, if you do that 7 or 8% preferred rate of return, I guess you can pay it current. So when there's money that comes in, you can pay your investors on that, or two, you can have that accruing, and then it becomes a payable to the investor at some period of time down the road. I'm not crazy about that, because it opens up kind of a little bit of a can of worms that if the economy starts slowing down and you're still paying that preferred rate of return, legally you got to continue to pay it. Sometimes you can get off deviation track with the investors versus the sponsor in the deal, that the sponsor is not making any money, and then all of a sudden the investors are making all the money, and then the sponsors are not doing the things that they should be doing. So I'm not always crazy about it.
Yeah, it just has a potential of disaligning everyone's interests versus just the other way, where it's just a straight split of every distribution. So that's kind of the way we've done it. Like Paul mentioned, if you get behind on your pref and you have to pay an 8% pref, but you can only pay out 5, the sponsor's accruing 3, they have to catch that up before they ever see their payday. So it really kind of disaligns the interest. The sponsors might make a different decision to try to sell the asset sooner, even though if they would hold on for another year or two, it'd be better off for the overall investment, but they're just getting more and more in the hole. So kind of looking up out of this hole, trying to figure out how the heck do I get out of it. So that's one of the risks by doing the pref with a waterfall. So moving to the next question, really on why do most deal sponsors, syndicators underwrite to a 5 or 7 year hold period? Wouldn't they be better off just doing a refinance, returning the capital, and kind of have a longer term hold? Also, to that answer, there's no right or wrong answer to that as well. I think a lot of it is really what type of investors do you have and what can attract capital, and then what's kind of really the best way with that particular asset you're looking to buy. So some of the things that we think about when we're putting these deals together, I mean, all these deals should kind of have a primary and a secondary exit strategy. Most cases, as the listener asks with the question, are a hold. And they typically underwrite 5 to 7 years, because that's kind of like a medium term or midterm time horizon. So when you're out there and you're a syndicator and you're taking in, $50,000 or $100,000 minimum investments from 20, 30, 40, 50 unrelated people, they want to see a return on their capital in the medium term. And, it's really hard to keep the band together for perpetuity. So having a natural end to the investment with a sale is certainly attractive to most people. Where they can see them giving you money, they get a little bit along the way, then they get a big pop at the end when you have your sale. So that's kind of the most attractive way there. There's nothing wrong with having an asset, improving the value, looking to refinance in a few years, returning most or all the capital, and then holding it for cash flow. That's certainly a viable exit strategy as well. But, your investors will tend to have a little bit longer, more patient view of getting a return of their investment, because certainly, you typically aren't going to be able to return all, if certainly not more than what you originally invested in the deal through the refinances in most cases. So it's certainly a longer return for them to see, a return on their investments instead of just kind of return of their investment. But, it's certainly a little bit more tax advantage by doing it that way versus having to pay capital gains. So really you just got to make sure when you're attracting capital that you clearly define what your primary exit strategy is, and then also identify what your secondary exit strategy is, and the investors that you take in, just make sure that their interests are aligned with what your investment philosophy is, because you don't want to take in all these people that are looking to get their money back, but you wanting to own this investment for 20 years. That's just you're just setting yourself up for future problems. So kind of think through that a little bit when you're putting the deal together and talking to investors.
I definitely like your phrase, keeping the band together is tough. I mean, that is absolutely true, is that If you're going to use the band analogy, I mean, there's a lot of the one and done bands that they were the one hit wonders. And then you have the bands like the Rolling Stones that keep on going on for 50 plus years. I mean, you're going to fall somewhere in between about trying to keep the band together. I think most of the time it's 5-7 years is actually on the long front of these transactions. As Mike and I like to say, these transactions, people buy these things in dog years. So for every 1 year you own, it's like having 7 years of a dog year. I mean, they do not own these things for perpetuity or something like that. So they want to be in, they want to fix stuff, they want to get out. They just don't want to have these long-term relationships with other investors, and neither is the sponsor. They want to move on and look and do their next transaction. So some great information, Mike, the smartest guy in the room. Anything else going on, Mike?
Yeah, we just certainly invite everyone again to go to our company website, which is www.oldcapitalpodcast.com. There you can also find the 17-page white paper, kind of the multifamily finance 101. You can sign up for our weekly emails. We'll kind of give you some information about the market, talk about some deals that we're doing, let you know about future events that we have coming up, not only the Old Capital Speaker Series, which you can sign up for at that same website, but we host these the Old Capital Speaker Series both in Texas, and now Paul's starting to go to California as well, and have guest speakers come and talk about the state of the market or certain aspects of it. So we try to provide as much value as possible for the people out there looking to do the multifamily space. We certainly appreciate you going to the website and signing up for our weekly newsletter as well.
Yeah, if people wanted to get more information on your company, Michael, who buys and sells apartment buildings under the SPI, which stands for what?
Strategic Property Investment. Certainly, yeah. If anyone wants to find out more information about what I do at my company, SPI Advisory, just go to our company's website, which is www.spiadvisory.com. That's SPI like spy advisory.com. There's a contact us page on the website. Fill that out, and we're always happy to set up a 10 or 15-minute telephone call with listeners of the podcast.
Absolutely. Again, Michael Becker, smartest guy in the room. I'm Paul Peebles. Have a great day.